What's up? What's up, everybody? Welcome aboard. I guess we're live. I don't know. I'm a little confused, but I guess we're live. And what's going on, everybody? Well, let me just come in and see it myself. Here I am, and listen. It's markets are slow. It's quiet. It's summertime. It's the dog days of summer. We've got 2 weeks until Labor Day. Don't expect much action in these markets over the next couple of weeks. As you can see, I'll show you my screen here as we're looking. You can see that these are 4-minute charts, which there's not very much action going on. And what we're really watching is declining volume on a short-term basis, which these are 4 minutes. And if we look at a full-time chart, okay, the daily, you're seeing the same thing. I mean, every day volume gets slower, volume gets lighter, which makes it more dangerous for you, the trader, when you have these kind of markets, because you start to see potential illusions of things you should be doing, when more than likely the best trade today, the best trade right now is really not to trade. Okay, volatility is collapsing once again, although the VIX is a little bit higher today with the lower movement, but we can't get volatility off the deck. We can't get the markets off the deck. The news is unsupportive to a market in either direction. This morning you had a big drop. If you go back and look at about 8:30 Eastern time, 5:30 Pacific, you had a big drop. Just on some Chinese news. But overall, you've got really a market of lackluster performance, and typically dull markets will try to drift higher. The overall picture, you just have to recognize that this is the time to study. It's the time to work on things. It's time to work on your game plan for going forward, because the overall action in markets will create more heartburn than it will create success. The key in trading, the key to true success is recognizing when markets are like they are now, that opportunities are not as plentiful. And again, when I look at things, especially if I'm trying to trade short term, it's where can I make money, and how many opportunities will I have? If you tell me that I'm only going to have one shot at it, I'm probably not interested in taking the one shot. Okay, I want to know that, for example, I'm looking at 8 charts here. Oh, let me bring it back to my charts. Hold on. Here. Okay. So I'm looking at 8 charts here on the 4-minute scale. Okay. So 8 charts on 4 minutes. In theory, I should have a potential of 120 opportunities in an hour. Okay. Now, again, I know I'm not going to have that many, but that's, if you just do the math, 15 minutes, 15 per hour times 8 is 120. So I'm lucky if I've seen today, for example, 3 or 4 opportunities in 3 hours. So do I really want to take the risk? Do I want to expose myself without going to jail in a chart, okay, in a market that is very inactive? And the true answer would be no. I don't want to take myself and expose myself, because these markets are not great for trading. And again, when the amount of opportunities that you have create the more success. It's like flipping a coin. We talk a lot about the laws of large numbers. So understanding yourself and understanding what your win rate might be. So I know my win rate when I'm day trading futures is 66%. Okay. So I don't want to have to wait 100 years to get enough trades to make that law of large numbers work out. I want those to work out much faster, because I know that my opportunities become much more plentiful, which gives me a much higher probability of having more success on a daily basis. So when we go into these where I might get, like this morning, for an hour, I traded live with my members. Okay, we had 2 trades that both ended up being, tiny profits, break even, we call them, enough to cover costs and never to maybe have a cup of coffee. But if I'm going to only have 2 trades in an hour, I'm not really all that interested. There's other things I'd rather do. And one of the things that you can always do for yourself is to start to study on your game plan and look for things that you want to do, going forward. You can deal with your money management skills. You can deal with your disciplines. Okay, you can deal with understanding what certain chart patterns will do, what to expect from those patterns. I'm not a big advocate of studying the news or reading the news, because to me the news is all crap. Okay, first of all, news that hits a market is pretty much already played out. Okay, and usually the reaction is an overreaction from the traders of that market that have already tried to pre-price something in, and if they miss, then you'll get a quick gyration. But even this morning, with the quick gyration, it was over in less than 2 minutes. So we're not seeing a massive amount of activity right now in these markets, which again takes away your opportunity. Okay, and when you give away your opportunity, every time you make a trade, you are taking less of an advantage than if the markets were much more active. Now, we're not going to always have the perfect market to trade into, but this market we know is not favorable. The conditions are not favorable. So it makes more sense for us to do other things now, because, preparation for markets, for trading, are a big part of your plan. Okay, and being prepared for what's next, and we know that it does take some study, it does take some work, and maybe looking back at some chart patterns, that might help you create successful opportunities for yourself would be more important than trying to navigate a market that is filled with challenges, that is filled with disadvantage to you, the trader. And that is, it's something that we can, talk about and work on. But as you're watching and you see at the slow pace, and if we take it down even slower, here's a 1 minute chart. Just look at how slowly the markets are working. Oh, thanks, guys. Look at how slowly the markets are working, how slowly the markets are moving. Okay, so these are just telling you that the overall opportunity, the speed that is in the market, okay, is not there. It is not creating much of a dramatic opportunity, which for you is again a disadvantage. So we always must be aware of and ready to trade in a fashion that we say, okay, here's a market that's moving. Okay, now again, if I'm charting, okay, now again, we see the NASDAQ on a 1 minute starting to move a little bit. This is the NASDAQ in the corner, starting to move a little bit. So is it creating an opportunity for me? Well, the volume is very mediocre. So if I flip it back to a 4 minute chart, you can see what I have. So is this really a true opportunity? And again, this would be where my charting skills might come into play. And I might say, well, I'm in a downtrend. Is this making a potential, double top? What I want to potentially sell into here. And so this is where you now lay into all the things that all the knowledge that you're accumulating over time. You're saying, well, when I look at this market, I see volume continues to fall off. So that's a disadvantage to me, the trader, because what I'm really trading, when you're trading a chart or you're trading the market footprint, you're trading a market that is you're trading against others, right? The business that we're in is a competitive business. Okay, the competition in which we lie in has different traders. We may be friendly competitors, but we're competitors just the same. Okay, so everybody's looking at these same charts. Everybody has maybe different moves or different methods of things they may want to do, but we have to learn how to recognize. Okay, how do you work with position allocation? If you had a portfolio with 100,000 percentage of capital, would you use per position? That would depend. There's a lot to answer to that question. It really depends on, am I day trading? Am I position trading? Am I swing trading? Am I doing, what type of trading am I doing? I don't really allocate a number to a position because it really depends on, is that position going to be for the long term or is it for just a 5 minutes? Because again, my risk model changes depending on what I'm going to do with the trade. If I'm going to trade on a short-term basis, like I do day trading, I don't really care how much allocation I use because I know I'm going to set the exact amount of risk with a stop to begin with. If I'm swing trading or position trading over a longer period of time, my risk has to be greater than my risk at a short term. So it's really hard to put allocation to it. I think the bigger answer to that question is if you're day trading, then the amount of risk is determined by the charts you're using and the patterns and the different products that you're using. And a simple amount of risk that I like to use potentially is like use what the average true range is for the period of time I'm changing. But if I'm going to trade longer and carry positions, then I want to have 3 to 4 times the amount of margin that is required in my account. So if I was going to leverage 25,000, that would give me 100,000 would be 4 times the margin amount. Okay, so I would be willing to go up to a $25,000 worth of leverage or a position, versus each position. Again, products have different value, but the patterns that I'm trading are going to be the same. So I don't worry about each individual. How much am I going to bet or play or invest in any one thing? Because obviously, different products are different sizes, but overall, I'm playing it as a mass portfolio, not each individual. Okay, so to me, I don't say that I'm only going to invest $1,000 or $5,000 per position. I will trade per position, whatever that size is. So if my size is trading, in options, if I'm trading one contract, okay, then there'll be one contract of all. Now they could be obviously different prices, because if I'm trading one contract of Tesla, it might be a $20 option. If I'm trading one contract of the spiders, it might be a $5 contract. Okay, but it's going to be based off the same premise, and it's going to go into the total balance of how much risk I am taking in general. Okay, I don't break it down by each individual because I'm trading the same pattern, but some stocks are going to be more expensive to trade than others based on volatility, based on price of stock, based on all kinds of things. Okay, so I hope that answers your question. I mean, I know it's not the greatest answer in the world, but that's kind of how I look at it. I can't worry that each individual. I'm looking at the much bigger picture. And again, going back to the laws of large numbers when I trade these things. So that's what I'm focusing on. And in here, again, here I'm looking at overall. Hold on one second, guys. Here I'm looking at overall the position. Okay, that we have a market that is moving, and I'm trading this on a day trading basis. So I've assigned my risk from the beginning. So I already know what that is. Okay, and I know on each individual product, my average risk is going to be, $100 to $200 per contract of what I'm going to trade using a micro future or whatever. So I know how to establish that risk as I move forward. And I think that's something that's important for you to understand is where is my risk model based on what, and how am I arriving at the amount of exposure I'm using to take. And typically what I use is the average true range is a good guideline. Okay. So if you go to a chart, and I don't show it here because I know them kind of innately in my mind, but if you go to a chart and you just look at, the ATR, okay, which is the average true range, that'll tell me what my risk is on any given future, on any given time frame that I'm trading. So I'm looking at the Dow future, okay, like on a daily basis, the Dow future right now, my risk would be almost 400 ticks versus if I take it down to, a let's say 5-minute chart, my risk is 38 ticks. Okay, so that again, everything is based on time of the chart, time of the market, and the risk that is based on, because what we're trying to stay out of is a market that's going to take us out by accident. Okay, we don't want to be stopped out by accident, so the stop placement is very important. And I think another thing that you want to look at is the when you end up setting a stop, if you're using a mathematical stop as we are, okay, one of the things you want to make sure you do as well is that stop that you're going to end up setting based on X amount of ticks, if that stop ends on a whole number, you need to move either above the whole number or below that whole number. Okay, you need to move above it or below it. You cannot set a stop in the area of a whole number. Markets have a tendency to go through those numbers on either side, so you must move away a little bit from that whole number. So if I had a stop, for example, let's say on the Russell on the Dow future, which would be, let's say it was 35,200. Well, I'd make my stop 35,220 or 210 because I have to get away knowing as an ex-market maker that we are going to run stops. We don't know whose stops they are, but we're going to run through them, okay, because we know that people typically are lazy enough to leave those stops laying at around a whole number because it just makes sense to them. But we know that we run through it. So we have to make sure that we can escape that area of getting run over as the markets run through those. It becomes an important part of your trading, okay? Because again, we have to be prepared as traders for everything that we do. Okay, we cannot make exceptions. Again, we're going to make mistakes, but we have to have preparation and know that things are automatic. So if I do A, I'm going to do B. So if I enter the trade, okay, then if I short here, okay, I know my stop is going to be 60 ticks above at 35,180. So that's automatic. My entry goes in, my stop goes in, and then I manage a trade. And how I manage a trade is by watching the actual footprint that's being created right in front of me. And that's how important the charts are. The charts are more important than any indicator that you may have. Learning and understanding the phases of markets and how they work. Okay, so as we look, you can see the YM, the Dow future, it's in consolidation. It is sitting on support right now. It traded all the way down to dead support, and it's churning in a range. Okay, and certainly we know that things can happen in either direction, but we can see obviously it's in a range. Okay, and we know that one thing's going to happen. This has to either break out of consolidation to the upside or the downside. Now, if I look at the footprint, okay, the probability favors now breaking to the downside. Okay. Now, will it? I mean, I can't guarantee anything. I can only tell you that the probability favors that the markets will break to the downside simply by the fact that we've seen lower highs and lower lows for the last 2 weeks. However, we are now on support, and certainly it wouldn't surprise me if we saw a bounce come from here versus the NASDAQ future, okay, which broke down from here, okay, set a new level of consolidation, and of course could certainly rally back to 15,490, but has a much higher probability of breaking to the downside. The S&P, which yesterday, I believe, yesterday reached resistance and failed right off of resistance. So again, learning and understanding the market footprint. The market gives you information. It is up to you to listen to the information that the markets are giving you. Okay. And again, it's not going to be a 100% correct trade all the time, but the footprint themselves, what is the chart actually tracking? Okay. The chart is tracking price and time. Okay. Whatever time frame you're watching, it doesn't really matter. Okay. It is tracking price and time. Okay. It is plotting out price and time. So I know that the footprint, what it's telling me, so if I can follow a map and have the discipline to keep my opinion out, okay, and continue to follow the overall map that is being laid out for me, all that does is creates my opportunity and my ability to have more success. Okay, if I continue to fight it by listening to the news, I mean, if you in all seriousness, who here would ever want to be long these markets based on the overall news that we're watching? Okay, and I find it hard to believe anybody would really want to be long here. However, what has the markets really done basically all year long? They've gone higher. I mean, the Nasdaq is up 40%. Okay, would you have wanted to be up? Would you have said the market would be up? Nasdaq would be up 40%? And the answer is, if anybody says they knew, you're a liar. Okay, you would have to understand, okay, that here we are. Okay, the market is going up, so why should I get in the way of it? But suddenly, we do have a certainly a change in potential trend. We have a change in markets. Okay, but we also know that we're in a very slow period. You have declining volume, which makes it more of a challenge. You have declining volatility as a rule, which makes it more of a challenge. So basically, this is a great time to study. This is a great time to observe. This is a great time to not necessarily participate in the markets, but learn to watch. And one of the best things to learn or watch about markets, if you understand that we call something a name of something called universal price. Okay. Now, what is universal price? Well, what it is that all charts are the same, all markets are the same, all patterns repeat themselves, and the shortest time frame is the leader. That before a trend or a market can change, it has to start in the short term. Okay. So if I go here and I say, okay, so I'm looking at the S&P. So I go to a 1 minute S&P chart. What do I have here? I have a market that's basically not doing a lot. It was a market that was consolidating, okay, at a lower level, popped, okay, and broke to the upside a little bit. Now it's turning back to the downside, but basically relatively neutral, not very committal one way or the other. Okay. If I take this same chart on the same product and I go to, let's say, 5 minutes. Oh, well, wait a second. Now it's almost turned itself upside down. Okay. We've gone from a market that looked like it might be going higher from consolidation to now it looks like it's going lower from consolidation. So let's flip it to a 20 minutes. Again, it doesn't matter. It's immaterial. Oh, it's clearly in a downtrend. Okay. And if I take it further, okay, to an hour, well, now I'm back to that same pattern I was at 1 minute with one exception. And the one exception is now the end of it is lower versus higher. Okay. But basically, I'm back in that little bit of a consolidation pattern. Okay. And now if I go to 3 hours, again, these numbers are random. Well, it's definitely lower. Okay. So the trend is definitely turned. And again, I go out to back to the day. And where am I? Well, the longer term is higher, but the shorter term is turning over, which would tell me that the trend is probably lower, which would then tell me that I'm probably going to be a seller of these markets right now into a rally. I certainly don't want to be a seller into support. That's like suicide. Okay. Selling a market into support or buying a market into resistance is like suicide. The probabilities are there's going to be a bounce off of that bottom that will give you a greater and a better opportunity to sell it. Okay. Versus trying to sell it here. It does not give you a great opportunity. Okay. And this is what you have to understand is even if you're wrong, you have, if you want to sell this market, you have to allow it an opportunity to bounce to sell it. So where would you sell if you were looking to short the S&P right now? What would you look for? Well, the first thing you want to do is you want to go down to a shorter term chart. Whatever shorter term for you is for you. It doesn't matter. They're all the same. I use 2 time frames when I'm day trading. I use 4 minutes for a long term, 1 minute for a short term. So I'm looking here at a 4 minute chart. So what I'm really looking for is if this will rally up to about 44.73, which is not that big of a rally, about 4 points, that would be a sell point that I would looking at. If it gets there while we're here, I'll make the trade with everybody with me. Okay. But that's what I'm watching. I don't want to sell it down into the hole here. Okay. You know, down here would have been, as you can see, would have been suicide. You'd have been already chasing money and wondering how you can get out. Okay. So now we're kind of just festering right around here, around this level. So we kind of find some support. So let's see if it'll pop up to, 44.73 or so, and we'll make a trade. I mean, I trade live every day anyway. It doesn't matter to me. I'm happy to share with you. But that's what I'm watching for, right? I know it should rally from there. And again, it doesn't have to be a huge rally. I'm looking for a rally back into support to create a double top, for example, in a market that is trending lower. Okay, and there you go. Okay, so here we are. So now we're here. We've arrived where I wanted to potentially sell it at. So I'm going to take one more step here, and that is I'm going to go to my 1 minute. Okay, and my 1 minute's at the same spot. And you can see the marks are the same. All I'm going to do now is wait for this 1 minute to stop going up. Okay, and I'm going to go ahead and sell it. I may miss this trade, but I'm ready to go. Okay, and pull the trigger. But I wanted to see if this does show me. Okay, and sure enough, I'm gonna go ahead and make the trade. You heard the ding. Okay, I'm in the market now live with you guys. I'm short at 44.72. Okay, now I have to set a stop right now. So where's my stop going to be? Oh, my stop is going to be up against this upper level, which I happen to have from before. My stop is going to be at 44.76. Okay, so I'm going to go off of that. I'm going to go 44.76.50 is going to be my stop, and we'll see. Again, if it works, great. If it doesn't, well, I'll be on to the next trade. Okay, and I made the trade, so you're getting a little bit of a pop. I didn't get my actual confirmation of what I wanted, but again, it was I wanted to make a trade with you while everybody's here, so we'll see what happens. Again, I'm not even watching it. I know where my stop's at. I know what's going on. So all I'm waiting for now is where we're going to go from here. So I'm going to go back to the format and see what it looks like. And sure enough, we're still sitting right at that little resistance spot. Okay. Okay. So we're not breaking out to the upside. Okay. And I go back and walk back into, the longer time. Okay. And I can just look at, again, we'll go back to 15 minutes and see here we are hovering right at that resistance level. So under any circumstances, it's somewhat of a potential sale here. And again, it may not work, but that's why I use a stop. So I already know where my exit is, and I can go about my business right now and not worry about this. I can watch it up here in the bigger scheme. And again, here's a spot we just about sold it at, and you can see that it is having trouble breaking through there. Now it may break out, and if it does, hey, it'll be a stop out. It won't be the end of the world because I know what the risk of my exposure is. Okay, and that's what you're watching on any one of these charts. I mean, here's crude oil. I'd be looking at a level here, but my one concern in these markets right now is the true lack of activity. So had I not been live with you, I might not have made these trades, right? But since I'm teaching, and it's okay, I don't mind if it does. Right now, it's about even, okay? And if it turns out to be a loser, it's not the end of the world, right? That's the confidence and the things that you build in the world of trading is understanding what you're trying to accomplish, how you're going to get there, okay? Because here, again, I'm not worried at all. My only thing I will be looking for now is if it fails to move in my direction shortly here, then I may be looking to adjust my stop if it can get back down and I can get a stop in around break even. That would be the only thing that I would be looking at now, but I'm not, again, I'm still comfortable. I mean, I'm comfortable either way. That's one thing you have to learn, right? You know that every trade is not going to be a winner. So those of you who think that every year is a winner and that you're going to get rich tomorrow, you're making a mistake. Okay, this is a grinder business. This is exactly what we're doing: finding opportunities and diagnosing them and making sure that we, at always, protect the risk. There's an old saying in sports: defense wins championships. Well, the same thing goes in trading. You got to defend your portfolio. You got to defend your position. You got to defend your money. Okay. So here we are. We're struggling along, not going anywhere. We're not in jeopardy yet. Okay. Now I've watched this long enough. Okay. And so now what I'm looking for now is I'm going back to my 1 minute. Okay. And I want to see, you notice how it held at the secondary level, right? Or we sold it. What I'm going to do now is if we can get this thing down a little bit, I'm going to put my stop to break even now, if I can get there. Now, I may still get stopped out at a full loss, but now I recognize that the market is not cooperating the way that I wanted it to go or what I was looking for. And again, this has a lot to do with these current conditions of the lack of speed, the lack of velocity into the market. This is what makes it more challenging. So what I'm going to look for now is for the opportunity to get my stop in at break even, because I'm willing to let it run if it goes in my favor, but I'm not willing to take the risk anymore. So if I can get to that point, now I'm not going to close the trade at a loss. It's either going to be a full loss where the original stop was break even, or I'm going to make a profit. So now I can put my stop in at break even. So I have a break even stop in my market, in my trade right now. And now I'm going to let it run. Okay. I'm not in a hurry to cover it. I'm not in a hurry to take anything out. If it breaks down, great. If it takes my stop, then I made a cup of coffee. Okay. My stop is based on enough to cover the commission, the cost of the futures trade, and to go to McDonald's for a cup of coffee. Okay. So that's the worst I can do on this particular trade. In the meantime, it's still going in. It's still coming back down. It hasn't stopped me out. And that's what we're watching. So we know where my stop is, right up in here. Okay. And here it comes back down. And I got a little bit more profit. And now I'm willing to let it run for a while. And I believe that it's going to come all the way back to here before I will move my stop if I move it at all. Now I might get stopped out first. But again, remember, I've taken the risk out of the trade. Okay. So that's one of the big things that we got to understand is I've already taken the exposure out. Okay, so all I can do is either break even, which makes a little bit of money, make a lot of money, or get stopped out. But so I'm out, trade's over. So I get coffee for one. Okay, that's what I make. Coffee for one, but it's no big deal. So now we're watching, and I'd go back and say, okay, so where am I at? What am I looking at? And I go back to whatever my time frame is. So now we're breaking through this level. So this would be the next one up at 47.75, which where I was going to use my stop loss, would be another spot if I wanted to start trading again. But again, I'm really not all that interested in trading right now because the markets are not cooperative enough right now. There's not enough action or speed or velocity to want to be active in these markets. And this is where, if you're trading options, they continue to crack the volatility, which is if you're buying volatility, you're getting hammered. Okay. If you're selling it, it's okay. But you have to determine, is this the market that you want to be selling volatility as well? Because what do we know about these markets right now? We know that they're extremely slow. They're extremely painful to watch. Okay. You're better off on the golf course, out to lunch, out to dinner, whatever time zone you're in, you're better off anywhere but staring at this stupid ass screen. Okay, right now. But if you're staring at it, okay, then you have to make good decisions. And good decisions better be based on a whole bunch of stuff, right? Speed of the market, chart pattern, what you're looking to do, type of trade you're making. All these things come into play and what is my real opportunity? Well, in a very slow market and light volatility, the volatility continues to collapse, but it's harder to sell it. It's easier to buy it. But again, it's not something that we want to do. So it is then creating positions that are over a long period of time. So what would be some things you might be trading in a market like this if you were trading? And again, my personal recommendation is to be very thin and very light right now. I don't think that trading right now is the optimum for individuals. I think right now is a great time to kind of plan your strategy, going forward, for after Labor Day, for what we expect. Now, again, certainly I would be trading calendars right now, because again, by using, if you know what a calendar spread is, which we'll get into more into option spreads and stuff, later on down the line, but you use spreads where you're selling short-term premium and you're buying longer-term premium, okay, so that you can at least offset cost and give yourself opportunity. Remember, the whole business that we have here is about the opportunity that we can create for ourselves based on the market footprint that we're watching. It doesn't matter if you're watching, Apple. Is there an opportunity in Apple right now? Probably not. Okay. I mean, we're certainly in a trend that has changed lower, unless we were a seller here. But now, when I'm looking at an equity, I don't day trade equities. Okay. I don't see the benefit or whatever in day trading equities. I think equities, when you trade them, you have to be able to give them a much longer lifespan. And there's a lot of reasons behind that. But one of the biggest reasons is the bid offer spread in the option market versus the bid offer spread in the futures market, which is why I can trade futures on a day trading basis, because I'm not giving up as much of an edge as I am on an option market, on a stock in the equity market. Plus the fact that the FINRA day trading rule, if I don't have 25,000 in my account, there's a lot of reasons to understand, but the biggest thing is you cannot afford to give up the edge of 20 to 30 cents on every option trade you make when you're trading an equity, other than, the ones that are very narrow. But, even Apple's within 10 to 20 cents, and you're not buying the bid when you're buying the offer. And when you sell, you're selling the bid. So you're giving up 20 to 30 cents on every trade in and out. That's $30. Now, that may not sound like a lot, but give up $30 on a 10 lot 5 times a week. How much is that? Sounds like about $1,500 to me. That's a lot of weight to overcome, versus on a futures on the same size animal, you're giving up $12.50 or $5. Okay. Big difference. And it's something that you have to understand. We all get the mindset that this is easy. This ain't easy. Okay. Trading ain't easy. Trading is hard. Okay. It's like any other job. Okay. It's great because you can do it anywhere. You can do it at any time, and you have the opportunity to pick your points and pick your times and pick your strategy. But at the end of the day, there ain't nobody handing out $100 bills on a street corner. In other words, there ain't no free lunch. Okay. It comes down to hard work and recognizing. So you have to understand the probability of what you're trading, because what is the options market anyways? What is the trading world? It's a probability model. No different than playing poker, gin, backgammon, or bridge. Okay. And those are all games of math and all games of probability, which is just what we're watching right now. We played the probability on one trade. It didn't work out. We didn't lose any money, but it didn't work the way we thought, and it's still hovering. Okay, let's just go back and see what was the end result if we had to trade a little bit differently. And there it is, still sitting around that same spot. Now it did reach our secondary target if I wanted to trade it, but I don't have interest in trading it, because right now, if I consider myself a 66% favorite in a normal market condition, then right now, let's say I'm a 52% favorite. Do I want to trade when I'm a 52% probability when I know I should be 66? Think about it. Again, you may laugh or scoff at these things that I'm telling you, but I'm giving you 44 years of experience doing this, from the floor side to the screen side to the education side. And I can tell you one thing for sure. that by forcing yourself into these markets and watching them too closely when there's not nothing to watch, you start to see mirages. You start to see things that don't exist. You start to see things that you put yourself in a trade, and suddenly in that back brain of yours, you had an opinion, and now you push that opinion into the market, okay, because you get nothing else to do. So again, I warn you that it's very important that you watch. And when you see this happening with the volume, which we're almost down to virtually nil, okay, and you're watching this lack of activity in these markets, where's your edge? Where's your point? How are you going to make money? And when you learn to recognize that the opportunities that are not really here right now, you will find yourself in a much better position, okay, without putting yourself in great jeopardy, okay? And that is the objective of the game that we're playing, because when we look at this, and notice I showed you where crude oil should fail, okay, and it did, okay? And again, and I'm not, this is not I told you so I was right. This is what you're looking for, because again, these are the kind of moves that you're looking for. This would have been a potential. Again, I don't typically like to discuss trades that I didn't make, because again, I like to have my skin in the game when I'm talking to people. But these are things that we did point this one out, okay, that this was a potential. Now, conversely, in the 10-year notes, this might be a place I'd like to be a potential buyer. And again, like I said, I'm really not trading actively right now at all myself. So I'm not interested in getting overactive just because I'm talking to everybody here. Okay. But these are areas that if I were watching, which right now I am watching because I'm here, but after this, I won't be watching. Okay. How do you calculate your ROI goals for the year? Do you do it based on overall size of your portfolio, or do you focus on individual trades? I don't ever focus on individual trades. I focus on my portfolio and a balance. Okay. And my goals are to make X amount of percent annually, but you have to start at a smaller scale. Daily is impossible to put a number on a daily, how you're going to do on a daily basis, because you can have a bad day, right? I like to look and I like to look for, let's say, for example, maybe 5% a month, okay, which does equate to 60% a year. But I like to break it down into components so they can realize I want to make realistic goals and realistic targets that are naturally, truly attainable. I think I know guys that, and I've made well over 200 or 300% a year. Okay. What's up, Mr. Buckeye? How you doing? Long time. How's the pharmacy business? You thought I forgot, didn't you? You thought I forgot when I met you with Xander at the park. I think you got to remember, okay, that it's the work that we take, and of course the market conditions are part of it. But your initial goals, your initial setup has to be based on what is reality, okay? And there'll be years that you'll far surpass what your overall objectives are. There'll also be years you may not make your objective. But that's why they have to be in reality to what you're trying to accomplish. Because if you get too far out of reality, you can't get there anyways. And you know what happens when you press? You know what happens when you push in these markets? You know what happens when you fight them? You get crushed. Okay, because awesome, good for you, Roger. Nice to see you, my brother. You when you put yourself in a position of pressure, you're almost a favorite to fail. And when you fail, it makes you harder. And of course, often failure brings the chase of the next trade. And you chase the next trade, but what happens? So you really create your own bad luck by continuing to chase down a market. You have to be have a realistic view of what your expectations are annually, monthly, okay, and follow those rules to how you get there, okay. And that doesn't mean taking all kinds of shots here and there to get there. It means that you have a game plan that should get you there based on all of that. So I don't know if that answers your question or not, but I do look at the overall portfolio, the individual trades. How could I know? I don't know what you're going to be, if somebody says, if I gave 5 trades, which is the best one? I have no idea. I can't tell you what the best trade is. I can only tell you that they're all the same and that my expectations are the same at all, but that doesn't mean that they're all going to work in that type of direction. Okay. Are there any questions before we call it a wrap? Because certainly we'll get more into stuff. And again, if you just remember to subscribe below on the link, okay, so that you get notification. And also remember that, if you do have questions, you can always, bring them in to me right from the beginning, or you can email me direct to it, bubba@bubbatrading.com. Again, we want to make sure that we make this not only a exciting show and educational, we want to help you make money and help you trade better. Okay. So I know I'm cutting it a little bit short, but there is stuff happens, as they say, and a root canal awaits me. So I'm going to be off to the dentist. So to all you, have a great day. I appreciate you all hanging out, and we'll see you back here on Thursday if I survive the dentist. Have a great week, everybody. We'll see you later.